Good morning, students. I have come with a new module, final accounts, that is accounting. Final accounts, how we will prepare, and this I am dividing it into small modules, and it will be really helpful for your examination. I know that you had that online teaching, so that you are not able to get all the required information. So this videos will be an additional input to prepare for your examination. So with this objective, I have prepared this module and I am happy to introduce this as small videos. Okay, final accounts. The first thing is, what are the three statements for preparing final accounts? One is trial balance, second is profit and loss account, and third is balance sheet. So these three statements, trial balance I have already covered in earlier module. We have done the problems also, so you have learned that. So this module we will be covering profit and loss account and balance sheet and many problems also. So this is how we are going to do this module. Now, if you want to prepare trading profit and loss account and balance sheet, see, these are the two basic statements. Trading and profit and loss account is one group and the second one is balance sheet. So trading and profit and loss account, whatever expenses, revenue expenses for the current year, we will debit, and whatever current income for the current year, we will credit. So that is how we will prepare the profit and loss account. And if the expenditure is of capital nature, it will go to the balance sheet. So this is the basic thing you have to remember. So now what you have to remember as the first step is, we have to distinguish between capital expenditure and revenue expenditure, capital receipts and revenue receipts, because this classification will decide which statement it will belong to, whether it will go to trading and profit and loss account, or whether it will go to balance sheet. So capital expenditure, if you see that, what are the capital expenditure? When you hear the term capital expenditure, you have to remember that capital expenditure is if you are incurring an expenditure and the benefit is you are going to get that benefit for number of years, then it is called a capital expenditure. See, for example, purchase of fixed assets. If you are buying a land, building, vehicle, anything, it is the benefit you are going to get for number of years. So that is why it is called a capital expenditure. So you have to remember that capital expenditure will go to the balance sheet, not to the trading and profit and loss account. Now the second one is expenditure in connection with purchase of fixed assets. So that you have to remember. See, for example, if you buy an asset, you cannot use that asset as it is. Sometimes you have to construct a platform to install that machinery. Sometimes you have to do some upgradation for that. So many expenses are required. So that additional expenditure to make that asset in working condition is also a capital expenditure. Next is expenditure for extension or improvement of fixed assets. See, sometimes you bought a semi-automatic machine. You want to make it fully automatic. So you are making some improvement. Similarly, purchased a vehicle. You want to convert it into an electric vehicle. So that is a capital expenditure. Next is architect fees for construction of a building. That is called as a capital expenditure. Next thing is expenditure incurred to acquire rights. Rights can be patents, copyrights, trademarks, all this. Because you know that if somebody will buy, a business organization will buy a right, whether it be patent right, copyright, trademark, anything, that benefit they are going to utilize for number of years. So these are all the examples for capital expenditure. Now we are coming to revenue expenditure. So when I talk about revenue expenditure, you have to remember that revenue expenditure will go to trading and profit and loss account. So what are the revenue expenditure? The expenditure required for day-to-day activities of the business. Say, for example, electricity, salary, printing, stationery, sundry expenses, bad debts, all this will be the revenue expenditure. Carriage inwards. Carriage inwards meaning bringing material to the organization or the manufacturing unit. Carriage outwards. You are sending the finished product to the customers. That is carriage inwards and carriage outwards. These are all our day-to-day expenses. Next is upkeep of fixed assets. You know that fixed assets have to be maintained. So we provide depreciation for fixed assets because at the end of the life of the fixed asset, we have to replace that fixed asset. If you are not having sufficient capital, it is not possible. So you have to remember that upkeep of fixed assets is an important thing. Repairs will be there, maintenance will be there, all this will be revenue expenditure. Purchase of stock. You know that if it's a manufacturing unit, without buying raw material, it is not able to continue with the manufacturing process. Similarly, they have to buy the stock if they want to sell that. So that purchase of stock will be a revenue expenditure. From the stock, when you sell that to the customers, then only you can make profit. So purchase of stock is a revenue item. Depreciation. Depreciation I have already mentioned. Depreciation is a revenue expenditure because if the asset purchased, the working life is expected to be 10 years. You have to remember that depreciation has to be provided every year. 1/10 of the value of the asset we will provide as depreciation. Now what is the advantage? That meaning this depreciation we will set up apart, and then at the end of 10 years this amount will help us to buy another new asset. So that is depreciation. So depreciation is also a revenue expenditure. Next is, we will see the difference between capital expenditure and revenue expenditure. So first item, if you see that fixed assets. Fixed assets, it's capital expenditure, and we are acquiring that fixed asset to get the benefit for number of years. Your capital expenditure, when you are buying a fixed asset, you have to remember that you are acquiring or you are purchasing, you are owning that fixed asset. In the case of revenue expenditure, if you relate with the fixed assets, you have to remember that we are only maintaining that. It will be repairs, renewal, all that for the fixed asset can be a revenue expenditure. Second thing is coming to the earning capacity. When you are buying a fixed asset, it's a capital expenditure, meaning it will increase the earning capacity of the business. The benefit you will get for number of years. Say for example, your building is on a rented building. Every month what you are paying, the rental expenses is a revenue expenditure. But if you buy a building, then you can save that rent so that it will increase the earning capacity of the business. Revenue expenditure will not increase the earning capacity, but it is required for the day-to-day activities of the business. Then the point is, we have to think about the third point, that is benefit. Capital expenditure, you have to remember that the benefit you will get for more than 1 year. Then only it will be categorized as a capital expenditure. A vehicle purchased, a machinery purchased, anything, the benefit you will get for number of years. Revenue expenditure, you have to remember that you will get the benefit only for 1 year. Salary, electricity charges, water charges, maintenance of the building, or anything like that, insurance, you are paying for 1 year. So revenue expenditure always we are paying for 1 year. Next is the financial statement. As I already mentioned, if it's a capital expenditure, that item will go to the balance sheet. It will be represented in the balance sheet. Whereas if it's a revenue expenditure, either it will be in the trading account or in the profit and loss account. That is the main difference. Next is, you have to remember deferred revenue expenditure. So the word revenue is important. Some expenses, revenue expenses. See, I already told you capital expenditure will go to balance sheet and revenue items will go to trading and profit and loss account. So you have to remember that some revenue expenses, if you spend for as a revenue expense, the benefit you will get for number of years. So we have seen the classification. It's a capital expenditure, meaning you're purchasing an asset, the benefit you will get for number of years. But a revenue expenditure you had spent and the benefit you're going to get for number of years. So what will be the situation? That is called the deferred revenue expenditure. The benefits of deferred revenue expenditure, you have to remember that the benefit will be, you will be getting for number of years. Advertising expenses. You know that companies will spend for advertising expenses, or any product. If they want to sell in the market, they should be informed to the customers. So they will advertise. So that advertising campaign is very expensive. So if they will put a good advertising, the benefit will spread for number of years. It's not a capital expenditure, it's a revenue expenditure. So you have to remember that it's a deferred revenue expenditure, because whatever the huge advertising expenditure you are spending this year, the benefit you are going to get in the coming years also. Next is preliminary expenses. Discount on issue of shares, or this preliminary expenses, whatever you are incurring as the preliminary expenses at the formation of the company or the formation of the business, that the benefit you are going to get for number of years. So that is also a deferred revenue expenditure. Then brokerage on issue of shares or debentures. You have to pay commission or brokerage for issue of shares or debentures. That also will be a deferred revenue expenditure, because the benefit you are going to get number of years. You are getting the amount, you are raising the finance by issuing shares and debentures. Next is, I already mentioned, that is the advertising expenditure. Advertising expenditure, always the benefit you are getting for number of years. Now, what are capital receipts? See, when you divide it between capital expenditure and revenue expenditure, there is definitely a distinction between capital receipts and revenue receipts. Now, what is capital receipt? Capital receipt is revenue obtained from sale of fixed assets. So, that is, if you are selling a fixed asset, after the earning capacity of that asset, you are getting an amount, that is a capital receipt, because when you purchased it, you showed it as a capital expenditure. Then is sale of investments. See, you know that if you have excess cash, they will make it in a proper stock market investment or any other form of investment, approved government securities or anything like that. So that meaning, if they are selling that, when the stock market prices are going up, you can sell that, or if you are in need of money, you will sell that item. So that you will get some income, that is sale of investments. Then issue of shares and debentures. You know, you have to remember that when the business organization is in need of money, they will issue shares and debentures to raise funds. So that is also a capital receipt. Next is balance sheet. So this you have to remember that capital receipts will go to the balance sheet. It will not go to the trading and profit and loss account. So this is also another important distinction. When it's an item of capital, if it's a capital expenditure, it will go to the balance sheet. If it's a capital receipt, then also it will go to the balance sheet. Now we have to see what all revenue receipts. So we have learned that revenue expenditure is there. If revenue expenditure is there, definitely revenue receipts also will be there, because we prepare financial statements based on receipts and expenditure. So both will be there. Revenue receipts will be there, revenue expenditure will be there. So what are revenue receipts? That is income earned from sales. You know that if it's a business organization, they have to do some service or they have to sell some item. That is how they will get the profit. If it's a banking company or insurance company, they will provide service for the customers. That is their income. Or if it's a manufacturing unit, say for example TCS or anything like that, HLL, they will sell their item. That is how they will make profit. So the sales is a revenue receipt. Next is dividend or interest received. You have to remember that if you have investments in other companies or in a bank, you will get bank interest, what are dividend, commission, all these are possible for your investments. Commission, see when you are doing some business, see for example a bank, that if a bank is selling the insurance products, they will get commission from the insurance company. This is not their main source of income. A bank main source of income is from their banking activity. That meaning that when they are selling the insurance products, they are getting commission. So that is a revenue receipt. Then you have to remember that you may have seen that revenue expenditures are going to trading and profit and loss account. Similarly, revenue receipts will go to the trading and profit and loss account. So that is how we will calculate the gross profit, gross loss, net profit, net loss. Always remember this distinction. If it's capital expenditure or capital revenue, it will go to balance sheet, whereas if it's revenue expenditure or revenue receipt, it will go to trading and profit and loss account. Oh, this is what I want to explain with this module. Thank you.